Welcome to Talk Tickers, where we break down the latest earnings calls so you don't have to. Today, we're diving into CVB Financial's fourth quarter 2025 results.
So right out of the gate, CVB Financial delivered an earnings beat, squeaking by Wall Street's expectations by a penny.
But when you look at the top line, the revenue, well, that was a slightly different story. They came in just a little bit light of the consensus number. Okay, so you've got a beat on one side, a mess on the other. But honestly, the real story here, the number that investors are really paying attention to, was this huge expansion in a key profitability metric. So let's get into it. Here's how we're going to break it all down for you. We'll start with the Q4 verdict, then get into that story of spreads, cover what management wanted you to hear, analyze the huge merger on the horizon, and we'll finish up with our own take on the next call.
All right, let's get right into it. First up, how did the quarter actually stack up against what Wall Street was expecting?
And what you see here is a classic mixed report card, really. On one hand, a solid 2.6% beat on earnings per share, coming in at 40 cents. But on the other hand, you can see that slight miss on revenue, which landed at about $134 million. Now, what's really fascinating is how the market reacted, or, well, how it didn't. You see this huge pop of over 5% on the day the numbers first came out, but then on the day of the actual earnings call, the stock basically did nothing. It's like the market priced in all the good news instantly and then just moved on. So if the headline numbers didn't really move the needle during the call, what was going on under the hood? Well, that brings us to the real story, the part that actually builds the bull case for this stock. Okay, now this is what got people talking. We're looking at the net interest margin, or NIM. And you can just think of NIM as a bank's bread and butter. It's the difference between the interest they earn on their loans and what they have to pay out on deposits. And just look at that jump, from 3.33% up to 3.49. That's a 16 basis point jump. And trust me, in the world of banking, a move like that in a single quarter, that is a huge deal. So the big question is, how'd they pull that off? Well, it was kind of the perfect storm, in a good way. First, they were making more money on the loans they were giving out. Those yields climbed nicely. And at the exact same time, what they had to pay for their money, their cost of funds, it actually went down. Earning more while paying less, yeah, that's pretty much the dream for any bank. And all of this plays right into management's core message on the call, which is all about one thing, and one thing only: consistency. I mean, just listen to this quote from the CEO, Dave Berger. 195 consecutive quarters of being profitable. Let that sink in for a second. That's over 48 years. We're not talking about a good streak here. This is a track record that has weathered multiple recessions, booms, and busts. It's their entire identity. And this timeline really puts it all into perspective. The profit streak started way back in '77. They started paying a dividend to shareholders back in 1990, and they haven't stopped since. That's 145 straight dividends. If you're an investor who values stability, that's a story that grabs your attention. So it's no surprise their strategy is basically, if it ain't broke, don't fix it. It's the same playbook: disciplined underwriting, not taking crazy risks, focusing on real customer relationships. They're feeling, let's call it cautiously optimistic about 2026. Oh, and they're still actively buying back their own stock too. Okay, so that's the story of the quarter. But when the call shifted to the Q&A session, all anyone really wanted to talk about was the future. Specifically, the massive catalyst that's just on the horizon. Yup, we're talking about the pending acquisition of Heritage Bank of Commerce. This is not some small bolt-on deal. This is the key event that investors are watching, and it's being positioned as the main engine for growth going forward. So management is telling us everything is on track. They're shooting for a second quarter close and to get the systems converted around the same time. But, and there's always a but with big mergers, right? You've got to get regulatory approval, you have the massive headache of combining two completely different IT systems, and maybe the hardest part of all, merging two company cultures. These are the big what-ifs on every investor's mind. Okay, so with all of that in mind, what's our take? Where does the stock actually go from here? Let's put on our analyst hat for a minute. So here's the fundamental question you have to ask yourself. You've got this fantastic margin story and a huge merger on one side of the scale. And on the other, you've got a tough banking environment and that slight revenue weakness. Which side wins out? Well, the bull case is pretty straightforward, right? The margins keep expanding, that merger with Heritage goes off without a hitch, and earnings just keep climbing. The bear case, that's where the revenue weakness sticks around, maybe the merger integration gets a little messy, and the broader economy throws a wrench in the works. So where do we land? For us, the positives here just seem to outweigh the risks. That upward momentum in their net interest margin is really powerful, and the strategic logic of the Heritage deal makes a ton of sense. So we're initiating coverage with an outperform rating.
And looking ahead to the next call, here's what we're predicting. We think earnings will probably land right around what people expect, but everyone is going to be laser focused on any merger-related costs. For the stock itself, expect it to kind of tread water for a bit, trade sideways, until we get a firm closing date for that deal. And the one number you absolutely have to watch, it's that NIM. Is this incredible expansion sustainable? That's the billion-dollar question.
And that wraps up our analysis of CVB Financial's quarter. As always, this is not financial advice.